So I thought I would look for the stocks with safe dividends with big moats. And you know what happens when you have safe dividends and big moats? Those safe dividends can stick around for a long, long time. If you want to see which stocks I came up with, stay tuned. Hey guys, Kevin Burgess back again with another video. Today, what I thought I would do is take the Simply Safe Dividends database screener, and I would pull all the dividend stocks that are labeled as a 99. I then limited it to stocks that pay almost a 2% dividend yield and had at least a 5% dividend growth. So I've got a decent size yield and a pretty decent growth in the model. And then lastly, I ended up looking for the stocks out of that list that were labeled as a wide moat from Morningstar. And guess what? I came up with 5 stocks that I think are really important for us to consider for our portfolio. And I want to go through those 5 stocks, but before I do, this channel is about dividend growth investing. It's about looking at dividend stocks. It's about me sharing with you what I've learned and what I've discovered. So if that's something that you're interested in moving forward, consider subscribing to the channel. I'd love to have you along for the journey. And with that, let's get started. So first on our list of companies that are safe but yet have a high moat is none other than Procter Gamble. Now Procter Gamble's on our list first because of their valuation. Let's take a look at Morningstar. Morningstar's done a valuation on them and have considered them to be at a fair value of $126. Their last close was around $141. So that puts them at about a 12% premium to their fair value. But should Procter Gamble be on our watch list? I would say absolutely. So let's take a look at Fast Graphs. You can see that over the last 9 years, Fast Graphs shows their pricing. Actually, it's a bit cyclical if you think about it, but it is up and to the right. They're currently above the blue line. The blue line is their normal PE ratio, which is around 23.35. They're trading in the 24.5 range in terms of PE. So it's probably not the right time to buy Procter & Gamble. But you can see back in October, we had a pretty decent buying opportunity for a stock that is perennially overvalued. I mean, look at this. It's only been undervalued just a couple of times. But we should keep our eyes open for another one related to Procter & Gamble. So now let's look at some of the details around Procter & Gamble. This is Simply Safe Dividends. You can see that their dividend safety score is a 99. Their dividend yield is 2.6. While their dividend growth is only 5%, with a dividend yield of 2.6 growing at 5% per year. That's not a bad number when we look at the future for dividend growth investing. Now let's stop right here for a second. You can see that their latest dividend increase in April of last year was 5%. Their last 5-year average per year is 5%, and over 20 years is 8%. So they're not lighting the world on fire in terms of the steepness of their slope here for dividend increases. But take a look at this dividend growth streak of 66 years. That is phenomenal. But what's even more incredible to me is that they have an uninterrupted dividend streak of 132 years. That dates back to 1890. Let's take a look at some of their metrics. Earnings payout ratio is in the 60% range. So that's pretty close to the kind of the limit for me. I think 60% is, for a company like Procter & Gamble, would be something that I think we would not want to surpass. Their free cash flow ratio has gone to 75%. So, it's something to keep an eye on for them. Their earnings per share has gone up and to the right. It's got this little dip in the mid-teens, and their cash flow per share seems to be dropping off here the last couple of years. Shares outstanding, they have bought back, a decent amount of shares, maybe in the 12% range. They were at 2.9 billion in 2013, and now they have 2.5 billion. Their sales, which is kind of an interesting smiley face curve here. It started back in 2013 at about 80 billion, and they have now roughly reached that level again. But another thing I find interesting is that their return on equity and return on invested capital has improved over that time frame. So it may be that they unloaded some of their unprofitable brands and focused more on more profitable brands. And that would be a great strategic decision for Procter & Gamble if that's what really happened. Their net debt to capital is 0.41, and they have interest coverage in the 35 to 40 range. So they have no issues with debt. And as Morningstar says, it's got a wide moat. They got great financials. So I'm going to put Procter & Gamble on my watch list, but it would need to probably get down in the low 130s before I would be a serious buyer. The next stock on our list, and in the order of valuation, is Merck & Co. We can see here that Merck is a pharmaceutical and has a fair value of $97. It's currently in the $107 range, so it's about 8% or so overvalued, 8 to 10% overvalued. It has an economic moat that is wide, but we can see, even according to Morningstar, they look well positioned for growth over the next 5 years. I think that is part of the reason they have such a high premium. I used to own Merck and ended up selling it last year. Probably not the best decision, but I had too many pharmaceuticals, and so I needed to get rid of some, and Merck was one of the ones that I got rid of. Let's take a look at fast graphs. You can see here that Merck has been pretty flat, I guess, over the last few years. It is up a bit in the last few months here since September, and has dropped recently. So it's, according to fast graphs, it's in a pretty decent buying range. But according to Morningstar, it is still overvalued. Let's look at some of their financials. You can see that they have a dividend safety score of 99. They have a dividend yield of 2.77%. Their latest dividend growth was back in November at 5.8%. Last 5 years, they have averaged 7% growth in their dividend. And over the last 20 years, not as much. It's been a slow 3% when you look at the last 20 years. When you look at dividend growth streak, they've grown their dividend for the last 10 years and have had an uninterrupted dividend for the last 51. Now, taking a look at some of their metrics, their earnings payout ratio is in the 40% range, so that's not so bad. Free cash flow payout ratios in the mid 40s. That's also not too bad. You can see their earnings per share is up and to the right. Their free cash flow has a bit of sawtooth to it, but it probably has to do with investments in companies that they're buying. Shares outstanding have gone from 3 billion down to about 2.5 billion shares. Total sales has a similar curve to what we saw in Procter & Gamble, a little bit of a smiley face here. But you can see that here, as of late, their sales have been growing pretty nicely. Return on invested capital and return on equity both growing at a nice, solid clip. Their net debt to capital is 0.3 with a 21.74 interest coverage ratio. So the numbers actually look very good for Merck. It is definitely a company we should consider. However, again, for me, it's overvalued, so I'm going to put that on my watch list and keep an eye on it. And for me, if it gets close to the just under $100, I will begin to get serious about maybe adding some Merck shares to my portfolio again. So it's going to start to get a little more interesting here as we get to stocks that are closer to fair value and even at a discount. So the next stock on our list is Johnson & Johnson. Johnson & Johnson is, again, a stock with a deep moat. It is, in full disclosure, a stock that I own. According to Morningstar, the fair value is around $164, and you see that they were trading around $169 when I filmed this video. So I'm still looking for them to pull back a little bit, but I may add some shares of Johnson & Johnson. Taking a look at fast graphs, Johnson & Johnson is pretty close to the line. They are up and to the right, mainly. Not a lot in either direction. They don't tend to go way up and they don't tend to go way down. They are just very steady Eddie. Let's take a look at some of their numbers. You can see their dividend safety score is 99. Their current dividend yield is 2.69. And again, not lightning growth here. Their latest was 6.6%. The last 5 years has averaged 6%. The last 20 years has averaged 9%, so that's pretty decent. But you can see this chart is up and to the right. What a beautiful chart that is for Johnson & Johnson. Another interesting point here is they've had a dividend growth streak of 59 years and an uninterrupted dividend streak of 106 years. That's not as good as Procter & Gamble, But you know what? That is about a 1916 time frame that they have had an uninterrupted dividend. That is impressive for Johnson & Johnson. Let's look at some of their numbers. Their earnings payout ratio is consistently in that low 40% range. They've got a bit of a bump in their free cash flow payout ratio. Their earnings per share pretty much up and to the right, except for the year of COVID. Their free cash flow has taken a bit of a hit this year. Shares outstanding, they've gone from about 2.88 billion to 2.66 billion over the last 10 years. Not a lot of share buybacks, but it is certainly a very manageable amount. Their return on equity and return on invested capital are solid in the mid 20% range. Net debt to capital, Johnson & Johnson has zero net debt. Their interest coverage ratio is 157. They've managed their debt very well. So like I mentioned earlier, if Johnson & Johnson gets down, in that 165 range, I'm going to be looking seriously at adding more shares into my portfolio. So let's keep moving. Next on our list of safe stocks with wide moats is Honeywell. I've never really talked about Honeywell before on any of my videos, but it is trading at a discount. According to Morningstar, you can see here that Honeywell is fairly valued at a 7% discount. This is an analyst report from Morningstar. They've actually reviewed their long-term assumptions and spoken with company representatives, and they're reducing their fair value estimate of Honeywell by 4%. So even though they've reduced that, it's still at a 7% discount. So let's look at it in fast graphs really quick. You can see that Honeywell appears to be a bit overvalued on fast graphs. It is trading at around 23.8 price earnings ratio, while their average has been 22.2. Let's look at some of the numbers here. You can see their dividend safety score is 99. Their dividend yield barely squeaks into our survey here. They have a 1.98% dividend yield. Their latest dividend growth was 5.1% in September of 22. The last 5 years has averaged 9%, while the last 20 years has averaged 8%. So you get a very nice, consistent dividend growth with a wide moat. It's going to be difficult to beat that over the long term. You can see their dividend growth streak is 11 years, while their uninterrupted dividend streak is 29 years. Let's look at some of their metrics. Earnings payout ratio is in the mid to upper 40s. Their free cash flow payout ratio is in the 50s. Earnings per share, you can see, is up and to the right except for the COVID years, so that's certainly understandable. Shares outstanding, they've gone from 792 million to 688 million, so pretty nice dividend buyback strategy. Their sales have dropped recently, so that would be something that I would want to check out before I bought into Honeywell. They have return on equity of around 30% and return on invested capital of 19%. Not stellar, but those are pretty decent. When I look at their net debt to capital, they're at 0.35. Their interest coverage ratio is close to 20, so they manage their debt very well. So a stable company with a safe dividend and a decent growth outlook. Now, according to Morningstar, they are at a discount, at a 7% discount. But when we look at it on fast graphs, it looks like it might still be a little overvalued. So for me personally, if Honeywell pulls back to around that 200 range, I am likely going to start a position. It may be small just to kind of keep an eye on it, but I would look for it to reduce to around the 200 level before I did that. So the last stock on our list today is Medtronic. Medtronic is, according to Morningstar, a company with a fair value of 112, but yet their last close was around 81. This puts them at a 27% discount, and it's something that we should really look at because they have a wide moat. And as we look at on Simply Safe Dividends, they have a safe dividend rating of 99 out of 99. They have a current yield of 3.28%. Their latest dividend growth was 7.9% back in May of last year. And over the last 5 years, they have averaged 8%. But look at the last 20 years, they've averaged 13%. So this has been a company that has grown their dividend consistently over time and someone that we should really pay attention to, I think. Their earnings payout ratio is around 50%. Their free cash flow ratio looks like it's bumping up here recently. Their earnings are pretty much up and to the right. They did take a hit in the COVID years. Their free cash flow is a bit wonky, but I think it's probably related to acquisitions. Shares outstanding, back in the 2016 area, they looks like they issued a lot of shares, and they have bought back a few of those, but not too many. Sales are up and to the right, so that is good. Their return on invested capital and return on equity, however, appears to be a bit low. Their net debt to capital is 0.23 with an 11 interest coverage ratio. So things other than their return on invested capital, everything else looks really good to me. Let's look at fast graphs. We can see that Medtronic was really, really high about a year or so ago, and now has dropped to a level which seems to be a buy range. Okay, guys, there's the 5 stocks. If you like this kind of video, consider hitting that thumbs up button. That would mean a lot to me, and it would let others know that the content in here is worthwhile. So if you wouldn't mind doing that, I would appreciate it. If you got any comments on these 5, or if you think I left something out that I should have considered, let me know in the comments below. And with that, I will see you on the next video.